Waiting just 10 years to start investing will cost you over $500,000. By the time this is over, you will know exactly how much delay is costing you, why almost everyone falls into this trap, and the 3 specific moves that change your financial future permanently. These are real numbers from real math, and they apply to you right now. Here is what the math actually looks like. Someone who invests $300 a month starting at age 25, earning the historical stock market average, accumulates over $847,000 by retirement. The person who waits until age 35 ends up with just under $300,000. Same monthly contribution, same returns, a gap of over $500,000. That gap does not grow in a straight line. The first 10 years look almost discouraging, like the money is barely moving. Then something shifts. After year 30, compound interest stops being a concept and starts being a force. The final decade alone nearly doubles the entire balance built over the previous 30 years. This is why time is the most valuable ingredient in the equation. Most people in their 20s and early 30s already know they should be investing. The problem is not ignorance. It is the feeling that there is always something more urgent, a bill, a short trip, a raise coming next quarter, a better moment just around the corner. That moment almost never arrives on its own without a deliberate decision. Every one of those reasons contains a grain of truth, and that is exactly what makes them so dangerous. Waiting for perfect conditions to invest is like waiting for perfect weather before you exercise. You will wait forever. The cost of starting imperfectly today is almost always lower than the cost of waiting for clarity that never fully arrives. The S&P 500 has returned an average of roughly 10.5% per year over the last 35 years. There were brutal years, the dot-com crash, the financial crisis, the 2022 sell-off. But investors who stayed through every one of those downturns came out dramatically ahead of people who waited on the sidelines for conditions to feel safer. The market rewards patience more than it rewards timing. I have spoken with hundreds of people who arrived at their 60s with deep regret. Not about which stocks they picked or which funds they chose, but about the years they spent waiting before they started at all. The one thing every single one of them wished they could change is the same thing you still have the power to change right now. Before a single dollar goes into the stock market, you need a foundation. 3 accounts form the structure that every serious long-term investor builds on. An emergency fund, so you're never forced to sell investments during a crisis. A tax-advantaged retirement account, to let compound growth work without the drag of annual taxes, and eventually a taxable brokerage for flexibility outside retirement age restrictions. The sequence matters as much as the actions themselves. Start with a $1,000 cash buffer in a regular savings account. That single move prevents most minor financial emergencies from becoming portfolio-destroying events. Then capture every dollar of your employer's 401k match before anything else. That is an immediate 100% return on your contribution before the market does a single thing. An index fund is the simplest and most consistently effective long-term investment available to ordinary people. Instead of betting on a single company, you own a fractional stake in hundreds or thousands of companies at once. When the broader economy grows, your money grows alongside it. The fees are remarkably low, and the long-term results consistently beat the majority of professional fund managers. A high-yield savings account earning 4.5% turns $10,000 into roughly $37,000 over 30 years. That same money in a broad index fund grows to over $174,000. Both accounts have a legitimate place in a financial plan, but they serve completely different purposes. Mixing them up, keeping long-term money in savings, is one of the most common and costly quiet mistakes people make. There's a simple shortcut called a rule of 72 that makes compound interest immediately visible. Divide 72 by your expected annual return, and you get the approximate number of years it takes your money to double. At a 10% return, your money doubles roughly every 7 years. Starting at 25, your portfolio doubles by 32, again by 39, again by 46, and once more before 65. Diversification is the principle that protects your money when individual sectors collapse. Owning hundreds of companies across dozens of industries means no single failure, no single bad quarter, No single bad year can permanently damage your portfolio. It is not exciting. It requires no skill and no daily attention. It is simply how ordinary people build extraordinary wealth without taking extraordinary risks. Every major stock market crash in recorded history has been followed by a full recovery and then new all-time highs. The 2008 financial crisis caused a 50% drop. The market recovered completely within 5 years and went on a triple in the decade that followed. The investors who sold during the panic locked in permanent losses. The investors who held or kept buying came out transformatively ahead. A straightforward 3-fund portfolio covers almost everything a long-term investor needs. A broad U.S. total market fund as the core position. A smaller allocation to international markets for geographic protection. A modest bond position as a stabilizer during volatile periods. Adjust those percentages based on how many years you have until retirement and how much short-term volatility you can tolerate without making emotional decisions. The investors I have watched build genuine, lasting wealth over 30 and 40 years share a single operational trait. They made their investing automatic. They did not rely on discipline or willpower or the discipline to watch the market. They set up a monthly transfer on the first of every month and then largely walked away. Automation removes the biggest single obstacle in personal finance, which is your own emotional decision-making in the moment. One of the most common paralysis points is whether to pay off debt before investing. The answer depends entirely on the interest rate. Credit card debt at 18 or 20% should be eliminated aggressively before any investing beyond the employer match. Student loans or car loans at 4 or 5% are a different calculation entirely. Below 7%, the historical market return likely outpaces the interest you save. The emergency fund is not a separate financial goal from investing. It is a direct protection layer for your investment portfolio. When people sell long-term holdings during a market downturn because they suddenly need cash, they lock in losses at the worst possible moment and miss the entire recovery. A fully funded emergency fund is what keeps your hands off your investments when life becomes difficult. Automating your contributions is the closest thing to a financial superpower that most people overlook entirely. When money moves to your investment account before it touches your checking account, you never consciously feel the reduction. Your lifestyle adjusts naturally to what remains. The investment compounds quietly in the background, and the temptation to skip a month never materializes because the decision has already been made. Study after study over the last 4 decades reaches the same conclusion. The vast majority of actively managed funds underperform simple index funds over 10 years or longer. The fees are the primary explanation. A 2% annual management fee sounds trivial until you realize that fee compounds against you just as relentlessly as returns compound for you. Over a 40-year horizon, that fee structure alone can cost you close to half your potential final balance. This is the actual shape of compound interest over a 40-year horizon. The first 15 years look almost disappointing. Then the curve bends, and the math becomes something that most people struggle to accept even when they see it. $300 a month, invested consistently for 40 years at the historical market average, becomes $1.6 million. The contributions total just $144,000. The rest is time doing work that you never had to do. Retirement is not an abstract future event. It is a specific date with specific numbers attached to it. And the distance between a retirement filled with options and one filled with anxiety is largely determined by decisions made quietly in your 30s. The people who arrive at 60 financially comfortable made those decisions years before anyone else noticed they were doing anything differently. The starting plan does not need to be sophisticated. Open a Roth IRA with any major low-cost brokerage. The entire process takes under 20 minutes. Set an automatic contribution of even $100 a month. Choose a single total market index fund and invest everything there. Each year, increase your contribution by 1% of your income. Review the account once a year. That is genuinely the entire strategy for most people. The numbers deserve one more look because the real shock is not the gap itself. It is how little extra money the earlier investor actually contributed. Starting at 25 instead of 35 means putting in only $36,000 more in actual out-of-pocket contributions over the lifetime of the investment. That 36,000 in additional contributions produces over 900,000 in additional final wealth. The difference is not income. It is not skill. It is only the decade of time that compound interest had to work. The best time to start was 10 years ago. The second best time is right now, today, before you finish watching this. Not after you read one more book, not when the market looks safer, not when your income is higher. The investors who build lasting wealth do not wait for certainty before acting. They start with imperfect information and incomplete amounts, and they let time do the work that willpower never could. 5 things to carry with you. Delay is the most expensive habit in personal finance. Index funds consistently outperform most alternatives over the long run. Automating contributions removes the emotional variable that destroys most investment plans. A funded emergency fund keeps your portfolio intact when life becomes difficult. And starting small with a commitment to grow beats waiting indefinitely for the right amount to feel significant. If this changed the way you think about money, share it with someone in their 20s or 30s who still has time to act on it. Every year they wait is tens of thousands of dollars that will not recover. The information here is free. The delay is not.